Yeah. Excellent. Well, good morning. And as you can see, I'm sitting here on Real Estate Chat with Robert Eade and good old Ron Hauth.
Good, yeah, getting
And
older. See,
sorry, man, I stepped on top of you.
though, and getting older. Glad of it, though. I'm glad it's better than the alternative.
Better than the alternative. Yeah,
Yeah,
anything that's not 6 feet under. Okay.
yeah. So,
So I guess we owe the audience a little bit of an apology. We missed June and the preview to July. There was just other things that got in the way, unfortunately, and relatives and who knows what that affect our thinking. And I had a computer glitch, Ron had a computer glitch, and so it just became not the most important thing. However, I want to make very clear that almost everything that we say on the channel is on UncleBobExplains.com. And if you look at something and you say, gee, I wish I could look at that again, instead of playing the video, you can go to UncleBob.com. And there's the chart that we were discussing. And you can blow it up on your own machine and you can look at it in greater depth and for as long as you want. So that's about all I have to say as an introduction. Ron and I are very happy that the real estate business has not exploded into terribleness, but we both are of the opinion that there's far too many properties that nobody wants that are for sale. And if you have 10 of those, if you're a registrant and you have 10 of those listed for sale, you've got 10 people who are very upset at you because you haven't been able to pull off the magic to make something that nobody wants sell for more than what they want to pay for. And one of these days, it's going to dawn on these folks that they bought it in a rising market, and now it's not a rising market. And one of the reasons why they bought that thing, which they're not living in, is because it was going to make money for them, and they were going to be able to sell it at an advantageous price in the near future, between 5 and 7 years from now, and be laughing all the way to the bank, and maybe even avoid any kind of taxation. So that's not the environment into which they are trying to resell that property. So everyone will have an epiphany. Some will take longer than others to reach the conclusion that we're going to talk about today. But there's a starting point, and I'm going to do a share screen thing here. And oh my goodness, are we seeing it, Ronnie? Can you see that?
yeah, what have we got here? Hold it. Not yet. Wait. Okay, got it.
Oh, it is? Okay, fine. So I'll come back to where we are. Oh, please. This one. Okay, so if I come back to our screen. Somehow I'm imagining I'll see our pictures on top of this this thing. Do you see the scrolling moving?
Yep. Oh, yeah.
Okay, well, as you talk, then your face turns. Okay, so here's all the rating. The Greater Toronto Area, Greater Golden Horseshoe, because people were moving farther and farther afield. They're going to Welland. They're going to past London to buy a property in their budget as an investment. And now that expansion of the Toronto market, Greater Golden Horseshoe, is contracting, and the furthest away is being damaged the most. The further away you are from Yonge Street, from the CN Tower, the greater the damage. Right now in 416, the price damage to real property is not as great on a percentage basis and on a dollar basis as it is further afield. There's just no investor clientele, which was about a third or 25% at least of the market during the roaring boom times. And so there's nobody buying those extra properties. And first-time buyers are very, very cautious, and they're always good for a quarter themselves. So half the market's on the sidelines. So when we get to it, looking at sales, we will not be surprised at all to find that sales in the summer of 2025 are 20% off the 10-year average, because there are huge segments of the market that are sitting on the sidelines for their own individual reasons and nothing else. So the big one that we're going to say to everybody is be patient. Decide what you want, decide what you don't want, and you're not required to do anything. If it's better for you to stay where you are because you can't refinance, there's many people that are sort of trapped into the property that they're in now because they can't refinance without it costing them a lot to pay that penalty, and anything else they bought would be more money and interest rate would be higher. And so they're, maybe you just got to stick there.
Yeah, we may
Okay.
see.
Sorry, Ron.
Oh yeah, I was going to say we may see more of a boom in renovating. It's cheaper sometimes, well, often to renovate or improve your situation, your own home, than it is to move if you weigh the expenses in it. I was thinking that maybe in the 905 too, or outside, a little outside the GTA where the land transfer tax is less, we'll see
Yep.
more interest. It's only half of what it is in Toronto, so we might see some activity.
Well, that's a factor for first timers. And it's ever since they brought in that Toronto land transfer tax, it's been a factor where people said, okay, this is cash money I have to pay upfront. It's eating into my down payment. And there's going to have to be some new thinking on why does the buyer have to pay that? Why can't the seller pay that on the statement of adjustments? Why can't it be sort of counted double? Anyway, right now, nobody is doing that. Nobody is thinking that. They think it's against the rules for anyone other than the buyer to pay that land transfer tax. But
Like there aren't
if
any rules.
everything, sorry,
No, I apologize. Yeah, there aren't any rules. It's whatever they can negotiate.
that's my opinion. However,
Yeah,
the convention has been established since the outset of this tax that it's always done this way.
right.
And so convincing sellers' lawyers, convincing buyers' lawyers that they should do things in a different way, maybe we can't do that, but we can get them to think about making an allowance on the statement of adjustments to counteract the effect that that double taxation has. However, until there's a crying need, no one's going to think outside the box, and we can say all we want about thinking outside the box, just like a vendor take back mortgage at a dirt cheap rate, or asking the person to put 25% down, asking the person to arrange a new first for 25%, and then taking back for half of the value that you couldn't have ever got ever again or before, a second mortgage, or what we call a wraparound mortgage. All kinds of
Right.
things that we never thought of because it was always a seller's market. The seller dictated you wanted cash, you wanted firm, you wanted no conditions. Now we're going to go through, I call it welcome to 1995, where people are glad and welcome buyers, and it's not a pain, and you get an offer and you work with it, both the agent and the person representing the buyer and the buyer, they all work to make it a deal. And we know that we're going to finally be kissing the butt of the buyer because they make it all work. So this is the screen we're looking at how at now. Buyers, as always, avoid unmotivated sellers. You cannot make a deal that you want to make with someone who's not absolutely serious about selling their house. And as for someone who's selling, the best possible price that you will accept as your asking price is the best magnet for drawing buyers to your home. You're not going to get 15 offers on one. No, people don't like that. Okay, so there's not lots of stuff in here that we're not going to go through. You got it on there in writing so that you can look at it sometime. So here we are with what we use every month to compare 1 year, 5 year, 10 years, 17 years, 20 years, and the maximum year comparison of where are we relative to all these other months. And the only observation I'm going to make from this, if we look at this chart and this big star, normally that's not what happens. Normally there's a bulge in April, May, and then it falls off. So maybe we're just missing the bulge and it's not really going straight up. And we're still at 20% off. But years in the months preceding this, we were 30%, we were 40% off the average. So whether the 10 years in July is always slower than the 10-year average in April is irrelevant. What's the pace of the market? And we're going to look at the pace of the market in a few minutes. But this chart, and you can study it later at your leisure,
Mhm.
tells you that last year was lousy. And so anything that compares to last year, like the Toronto Real Estate Board's Market Watch is trying to do, is misleading because comparing to a low base is going to give you a favorable result. And it's just, we're not shills. We're trying to give you an accurate presentation.
Yeah,
Okay,
they're
go
always
ahead.
pulling those statistics out of context, I think, or without the right context. Anyways, the previous month and the previous year would give you a better picture of what's actually happening, short and long term.
Absolutely. Sometimes we look at month to month. We try and look at everything the same way all the time and try and make it clear rather than trying to switch back and forth to make it most favorable appearing when all we want to do is reflect the reality. Okay, so this next one, which is, if I can get it to move, is what I call the school year, where it starts in September and ends in August. And the reason for it is to show that lull in the winter, December, January. And the reason for that is because it's cold. And the reason for that is most sales are arranged 2 months before the people move, the buyers and sellers move. And so who wants to move in January? Nobody. So that's why sales in December allows it.
Right, and second to that, they like to move when their kids are out of school.
That is what everybody tries to do, is
Yeah,
coordinate for the
warm
summer.
and warm and
Okay,
convenient, and kids are out of school, so it's not a huge upheaval in their school year.
right. So Mitch Corman said to us, the market's just fine. All you got to do is look over $5 million. Well, we can't look at over $5 million. We can look at over $2 million, and there is a seasonality up and down of all these things. And there are more houses that exist over $2 million, but there's still quite a healthy share. I'm going to say, in keeping with the average, over $2 million, and that's not as outrageous a luxury deluxe home as it once was, but it's a good benchmark for what is the upper end doing at this time. Now, prices I'm going to look at compared to every other year. And we're in the same pattern for prices. We're fading a bit in the summer, but that's the summer lull.
Right.
And we're still experiencing at 1,051,719, the fifth highest June ever. So here's the world record year, but then all the rest of them are sort of in the same range. And we've lost 5% in a month. We lost 5% in a year. And it's not the end of the world, but that's the trajectory that we are on. That this next chart is supposed to talk about the effect of inflation. And I think the big thing is, this is covering it. The biggest month, if we adjust for inflation, that's what the purple does. We're off that by 28%, because this 20% that was built in by, during the COVID times, where all the prices, all the gas, energy, everything went up. The price of everything went up by about 20%, is still with us. And now some of those things have withdrawn. And as our prices drip down with what seem to be higher interest rates now in the fours, the difference in what people were prepared to pay at an adjusted 1.4 to 1.05 is significant. That's 25%. Now, everybody is saying, when will the prices come to the bottom? We're waiting for lower prices. We're waiting for lower interest rates. You can't have both. As soon as interest rates seem to be at the bottom, then that will be the indication for everybody to buy now, and that will push prices back up. So we can only forecast so much. The rest of it is, I call it supply, demand, and consumer confidence. And we said at the outset, and the next one we're coming to is inventory. There's just far too many properties that people don't want for sale. And consumer confidence, Ron, you were mentioning this before, is not high. What do you think about consumer confidence right
There are people interested but not ready to pull the trigger. They just the too many uncertainties in the markets. The stock market's erratic. It's going up at the moment, but who knows what might happen next. The erratic quality of the tariffs in the U.S. To and from the U.S. It's going to affect everybody. I think the uncertainty rather than the actual tariff is probably as bigger. It's as big a problem, if not more.
now? Uncertainty. I think you're right on that.
Yeah.
Okay, so if we look and try and compare yours, it's not as bad as it's been once, but nobody wants to go back to when it was really terrible bad here or terrible bad here in '08.
Right.
That we're up to about 5, a little bit less, a little bit more months of inventory, which all you can say from that is it's not a seller's market. We were down here in a seller's market at 2 months of inventory, which is taking the all of the properties that are for sale on the last day of the month and dividing that number by the number of sales that month to come up with months of inventory. What is the pace of the market? How many months of inventory at the current rate of sales exist? 5 is not a boom market. Here's the same thing that Ron was showing on a much longer scale of, it was over 8. 5 is not 2, but it's not the end of the world. If you have something that everybody wants, and I believe that something that everybody wants is being supplied in existing neighborhoods for people who have lived in that property, selling it, they've lived there for more than 10 years. And so they are in a position to sell and not lose money. Someone who's lived there for 35 years, they can sell and never lose money. And if that's now property is gone, one of the spouses has died, both of the spouses have died, it's now being sold as an estate sale. That's where an opportunity can be gleaned if you're a buyer. You may have to do a little bit of work on it, but once you've got that lot, once you've got that location, once you've got that school district, you can make it into anything that you want. Now, my famous bugaboo or favorite bugaboo is the new listings and the way they report it. And the new now sales to listing ratio used to be reliable, but now it's really not, unless you make an adjustment for what we call relists. The board used to keep track of it, but they stopped doing that automatically. And so I'm just saying that 25% of every new listing that comes through is a do-over. It was already on the market, came through as a new listing 2 weeks ago or 2 months ago, and
Right.
it's just a repeat. So what do you think about that estimation of 25% of them are relists?
That's misleading for sure. It gives people the wrong impression of what's going on. And with the this new excuse me, a realm system, you can actually look right on the listing and see the existing listing and see exactly what's happened
It's
over the
right
last
there.
2 years.
So do you think 25% is a fair, I'm using that to say what the real number is by just subtracting 25%. Do you think that is too generous or it's not high enough, or what do you think about a quarter?
Might even be a little higher now than it was, but 25% is not unfair at all. I think that's fine. That's probably
So that's what this chart is supposed to be trying to indicate. The blue line on the top is what is reported every month in the Toronto Real Estate Board's Market Watch, the official results. And this line underneath it is taking off the 25%. And what it goes to show you is that this is the number of new listings that is being reported as a benchmark and dividing the sales into that to come up with the sales to new listing ratio. And it's very low now in the 30s. But in actual fact, if you subtract the do-overs, the number of new listings is very much in keeping. It's actually a tiny bit below the 5-year average and the 10-year average for real new listings, because people weren't doing it in a boom market. If the house sold in 7 days, you don't need to do a relist because it's gone. But if it's languishing after 3 weeks, you got to do something to stimulate activity and try and trick people into thinking that it's a new and glorious new thing. So the sales to new listing ratio is an old benchmark, and this is how it's affected. This black line is the adjusted by 25% subtraction. And the bottom line is if you look at what the Toronto Real Estate Board is putting out, they're saying that only 35%, 34.63 of the listings are selling, which makes it an ultra buyer's market. Buyer's market starting at 42.5%. But in actual fact, if you take away the do-overs, the net listings divided by the number of sales is 46%, which is not far off the long-term 55% average. It's not up to there, but we've got a lot of debris that's getting in the way of a clear picture. And what else? Sorry.
That's a good way to put it.
Okay. So the final thing, which I'm going to talk about, is because we're all relying on the people who analyze the information that's put out in the market watch, we have to be very careful of the tendency for them who are looking at something after the fact, not in the field, trying to gain understanding by computerizing the data, seasonally adjusting. You cannot make January into May or October or July, no matter how hard you try. And a seasonally adjusted real estate stat is something great if you're trying to compare 10-year stretch. But if you're not doing that and trying to make each month the same, because each month is not the same. And I suggest that most people who are a buyer, most people who are a seller are intensely looking at the neighborhoods that they're interested in for 2 or 3 months. Maybe they'll start casually looking 2 years before that, 2 months before that. But they're intensely looking at it the way we look at it for 2 or 3 months. And so these variations that are adjusted for inflation by .1 or .2, we never even notice it. That I think price is always the biggest consideration. That if I can pay $1 million, then I'm only looking at things that I can buy. I don't care what offering at 500,000, great deal. I don't care what's being offered at 2.5 because I can't buy those. I'm not able to buy them, so I'm just shutting them out from my
Right,
point of
that
view.
makes
I'm
sense.
focusing on what I can do. So that's all the charts that we have for today, because I think those are the only things that aren't being talked about by everybody else. Look at this relist phenomenon, which I hope they penalize people for abusing the ability, the privilege you have to terminate a listing and put it through the system again.
Yeah,
But I don't want to keep on looking at the same old thing time and time again.
yeah, it
But
looks like it's going to be pretty predictable every month that there will be a certain number of them. They
that's
did say at one point, I thought they were going to try and stop that, make it difficult.
yes,
So
agreed. So
fines,
I hear that, but I don't see that. So until
yeah,
I see
just
that,
say,
then you know, everything gets attempted and phased in, and until it finally takes effect, it's still something that we're going to be wary of, and we're going to point out and say, watch for this.
yeah,
So
they said they were
I
going
was,
to do it, but haven't. So
I'm sorry, I talked on top of you there, Ron.
that's all right. They said they were going to do it, but haven't done anything about it. They said that that was their objective, but
Apparently,
that was quite
apparently,
a while ago.
yeah. So I'm going to say that there's absolutely nothing wrong with the market right now, except it's not selling properties at the prices that they used to be. If you're there is no spec buyers, there is no investments. It's only owner occupied end users that are looking, and they are looking for the best deal possible. If you're a seller, you can appeal to them with financing, you can appeal to them by the price. Really look hard at what you're going to do with the money once you receive it. If you can get 10% more than you can on a cash basis with financing it, maybe that's better for you. What are you going to do with the money? Anything you want to throw in, Ron, as a different?
No, I have had a couple of inquiries lately from investors, actually,
Yes.
saying
Okay,
this,
good.
just saying this looks like a good time to buy, or to consider buying. Can you look in a certain area for me, and
Mm,
we'll try some low offers and see what happens. They're just sitting there. A couple of guys, serious, that have done well in real estate over the years, buy and hold, are thinking long term, and this is a good time to buy when everybody's selling.
when everybody's selling, that's right. So contrarians always win. And if you're not compelled to do something, don't be compelled by some artificial influence.
Right. They can just afford to wait until the right deal comes along and make an offer. And if it doesn't work out, they move on to the next one because there are lots to choose from.
That's right. There's
Yeah.
no charge for making an offer.
Nope.
Okay, so I hope that we still have a few folks that are paying attention to Real Estate Chat on YouTube when it comes out. And thanks very much for paying attention, and thanks very much for participating, Ronnie.
No, thank you. Thanks for having me. As always. Appreciate it.
Okie doke.
I always learn a lot. All righty. Well,
All
cheers.
right. My goodness.